Good morning. We'll talk about Chapter 9 today. Sorry we couldn't do it in person, but this might be better for you anyway because you can stop the video and make sure you understand what I'm talking about. So we're still moving down the balance sheet. We're down to long-term liabilities. And then we're on to Chapter 10, Stockholders' Equity, and Chapter 11, cash flow statement, and we're finished. We're almost there. So you've probably heard people talk about financing and capital structure in the same sentence. So what we mean by capital structure is what's the mixture of liabilities and stockholders' equity that a business has. In other words, how much of their financing is obtained by borrowing money versus obtaining investment from stockholders in selling stock. The cost of financing, if they have debt financing, then they have some interest. If they have equity financing, they may have dividends, but that's not always true. Examples of debt: notes, leases, and bonds. Most of those are long-term liabilities, and that's what we'll talk about today. Up until now, we've talked about loans in terms of they borrow the money and they pay it all back at some later date, sometimes a year later, sometimes 2 years, sometimes 6 months, but that's really not the way it works normally. We have installment notes. So if you buy a car, you don't just buy it and then pay for it all at some later date. You make payments on it. Those are called installment notes. Each installment payment includes both interest on the borrowed amount and reducing the actual loan balance. And companies do this as well, borrowing cash using installment notes. So we calculate the interest on an installment note by doing an amortization schedule, and that's what this is. It tells us how much they borrowed. It tells us the cash they're paying each month, so this is their payment, how much of that payment is interest, and how much of that reduces the actual debt. You'll notice that the interest amount goes down over time and the amount applied to the debt goes up over time. And we'll talk about that as well. But first I want to go over this concept of time value of money. This isn't actually included in this chapter. It's included in an appendix, and I've taken this information out of the appendix because I want to go over it with you. If you have trouble with the time value of money concept, be sure to go to Appendix C and read about it. So money does have a time value. In other words, $1 today is worth more to me than $1 in 1 year. And using $1 is probably not a good example. $100 maybe. $100 today is worth more than $100 a year from today. Why? That's the question. Well, the answer really is that I can earn interest on that $100 because I don't need it for a whole year, so I can actually earn interest on it. The time value of money is interest. We use time value of money concepts in a lot of different ways in the accounting and business world. This also introduces the concept of simple versus compound interest. Let's talk about what I actually mean by that. So in simple interest, you put $1,000 in a savings account and you earn 10% per year. So $1,000 times 10% for the first year, times 10% for the second year, times 10% for the third year. That's $1,300 altogether because you're making $100 interest each year. That's simple interest. Almost nobody does simple interest. Instead, we do this compound interest. So you put $1,000 in a savings account. At the end of year one, you earn 10%, so you earn $100. Now you have $1,100. They have to pay you interest on the $1,100, not just the original $1,000. So you'll see that the simple interest is now compounded. So instead of making, let's see, instead of making $300 in interest, we're making $331 in interest. So we're going to talk about present values in this chapter. So the present value of a single amount is how much that amount today will grow to be in the future. So in other words, $1,000 today will grow to be $1,331 3 years from now. If I need $1,331 3 years from now, how much do I have to put in the bank today, given interest rates of 10%? That's a present value concept. So here we know it's going to be $1,331. The present value of $1,331 at 10% is $1,000. There's a formula for that because it's compounded interest, so it's not easy to calculate. So here's the formula. You don't need to memorize it. You don't even need to know it. But there's several ways that we can actually calculate present values given an interest rate and an amount. We can use tables that are in the textbook. So we can say 3 periods with interest rates at 10% gives us a factor. That factor is actually that formula that I just showed you, worked out to a number. So you take 1331 times this number gives you the present value. That's one way to do it. You can also do it in Excel if you like. Let me just back up. You can also do it in Excel or in a calculator. So there's several ways to calculate this. I'm not going to ask you to do present value calculations, but I want you to understand what they are. So that was present value of a single amount. What's the present value of $1,331 today? If I need $1,331 3 years from now, what's the present value of that today? Then there's the concept of present value of an annuity. So there's periodic payments. So you may have several payments. What's the present value of those payments today? So you're going to get a payment of $1,000 at year 1, $1,000 at year 2, and $1,000 at year 3. What's the present value for that? Well, you could do each one separately. The present value of $1,000 1 year from now, given 10% interest, is $909. The present value of $1,000 2 years from now, given 10% interest, is $827. And 3 years is $751. And if you add all those together, you can come up with a present value of these 3 payments. There's a better way to do it, obviously. That's just the long way. There's also present value of an annuity table that factors that in. So you'll get a factor, we call these factors, 3 periods at 10%, multiply it by the $1,000, and you get the $2487. So that's one way to do it. You can also use a calculator or you can use Excel. Those are present value concepts. So when we talk about present value, that's how we get those numbers. A lease. So now we're going to apply that concept to a lease. This is a contractual arrangement. You lease something, that means you have the right to use it for a specified period of time. So the leases are recorded as a debit to a lease asset and a credit to a lease payable. We used to have different rules. They've changed in the past couple of years. So lease accounting became very complicated in the past couple of years. And I'm just going to give you the basics on it. So we record this lease at the present value of the lease payments. So you're going to pay, say you're paying $1,000 a year for 3 years. Then the present value of that lease payment is that $2481 or whatever that number we came up with in the annuity was. So we record this at the beginning of the lease term by debiting the asset and crediting lease payable. And we can actually do that in Excel and come up with those numbers. And this is how we record it. This is the present value of those lease payments using an interest rate. And we'll talk about interest rates in a bit. I want to talk now about bonds. This is what we're going to focus on mostly in this chapter. A bond is a debt instrument. So the way bonds are paid out is if you purchase a bond from someplace like City of Tucson, they're issuing bonds to repair the roads. So if you purchase a bond from the City of Tucson for, let's say, $1,000 bond, it's a piece of paper and it has on the amount a specified maturity date and the interest rate that they'll pay over the life of the bond. And they'll pay interest a couple of times a year on that. So you have this bond that you've purchased for $1,000, or well, let's say $10,000. The borrower, you're loaning them money, so you're going to give them $10,000. They're going to give you the $10,000 back at the end of the bond, the maturity date, but they're going to pay you a specific interest rate on that $10,000 over the life of the bond every 6 months. Bonds can be secured, unsecured, they can be term bonds, serial bonds, callable bonds, convertible bonds. There's all kinds of bonds. Don't worry too much about that. We're just going to do basic bond accounting. So, example. On January 1st, California Coasters raises money for development of its new roller coaster by issuing $100,000 of bonds, paying a stated interest rate of 7% each year. The bonds are due in 10 years, but they pay interest semi-annually. That means twice a year. So they're paying this 7% per year, but they're dividing it into 2 payments. So 3.5% for the first 6 months and 3.5% for the second 6 months. So the way the bond works is on the issue date, we have what's called an issue price. How much will you give California Coasters if they promise to pay you $100,000 at the end of 10 years and they promise to pay you 7% interest on that, or $3,500 every 6 months for the next 10 years. The issue price is how much you will give them. And the issue price depends on the market rate of interest. But first, let's talk about the bond issued at a face amount. That means it's issued at whatever is listed on the bond, $100,000 worth of bonds that pay 7% interest, and it was issued for $100,000. So you, the company, California Coasters, are getting $100,000 and you have to pay back $100,000. So you're going to debit cash $100,000 and credit bonds payable. The first time you make a payment, it's going to be on June 30th. You're going to debit interest expense and credit cash. And this is the same entry you will make every 6 months for the next how long was it? It didn't say. Oh, maybe it did. However long the term, I think it was 10 years. Now, what I've said was the interest rate depends on, or the price of the bond, the issue price of the bond depends on the interest rate. So what is the interest rate? So the federal funds rate, and I just updated this a few days ago, this week was 4.75%. This is the rate at which banks lend to banks. So banks have to keep a certain percentage of their money on reserve, and they don't earn interest on it. So they try to loan out that money back and forth to other banks to keep the proper level. This is the federal funds rate for let's see, February 28th, 4.75%. A year ago, it was 0.25%. So it's gone up dramatically. It's also used to control inflation by the federal fund, or by the Fed, the Federal Banking Commission. So every interest rate you look at is set by the federal funds rate. I just want to point that out because we talk a lot about the rate we're using here, and it's hard to figure out where it actually comes from. So there's a stated interest rate versus a market interest rate. The stated interest rate is the one that's actually on the bond contract, on the piece of paper you get when you purchase a bond. The market rate is based on that federal funds rate. So bonds can be issued at the face amount, meaning the market rate is the same as the interest rate. They can be issued at a discount or they can be issued at a premium. So how do you calculate the issue price of a bond? It's the present value of the bond's face amount, the $100,000 at the end, plus the present value of those periodic interest payments, those $3,500 every 6 months. To calculate those present values, we have to know the face amount of the bond, the interest payment each period, and the number of periods until the bond matures, and the market interest rate. Everything is on that bond except the market interest rate. So if we issue $100,000 worth of bonds paying 7% interest, but we issue it at $93,205, it's issued at a discount because the market rate is 8%. This bond is only paying 7% and the market is paying 8%, so we're issuing at a discount of $93,205. How do we record that? Well, we're actually getting $93,205. We still have to pay back $100,000 at the end. We post this difference to an account called discount on bonds payable, and we're going to do some examples of this. So hang tight. This is what it looks like on the balance sheet. Bonds payable less that discount, which is the entire discount, gives you a carrying value on the bond. This bond, same bond, $100,000 worth of bonds paying 7% interest, but it was issued at a premium, $107,439, because the market rate was 6%. So our bond is paying more than the market, so we are going to issue at a premium. Every bond is priced to yield the market rate of interest. So this bond is priced to yield 6%, not 7%. All right, how do we enter that? Well, we got $107,000 in cash. We still have to pay back $100,000 at the end, but now we have a premium on bonds payable. And this is what it looks like on the balance sheet. $100,000 plus the premium on bonds payable gives us a carrying value of $107,439. We will amortize the premium or the discount over the life of the bond to make sure the carrying value is exactly $100,000 at the maturity date. And that's what we'll work on this class, is how to do that. We're going to do some examples of that, and that's all we'll cover for chapter 9. Okay, our examples, I have all these on a spreadsheet, by the way, and I will upload a blank one and I'll upload one with the solutions. So we'll start with E92, which is an installment agreement. Installment note. So on January 1st, Tropical Paradise borrows $50,000 by agreeing to a 6% 6-year note with the bank. Their payments are $828.64 at the end of each month. The first installment is due on January 31st. So we're going to record the issuance of the note payable in the first 2 monthly payments. So on 1/1/24, we borrowed money. So we borrowed cash. We borrowed $50,000. We debit cash and we credit notes payable. And we're going to post the notes payable to the account so we can watch that balance. Sorry, that number is too big. Okay. First two payments. First payment is due on January 31st. We have some interest expense. We also are going to reduce our notes payable, and we're paying cash. We know how much cash we're paying. We're paying $828.64. That's always going to be the amount of cash we pay. The question is, how much of that is interest? So to calculate that, we can just do that off to the side. We're going to take the note, $50,000, and we're going to multiply that times 6%. And that will give us $3,000 a year in interest. We want 1 month's worth, so we're going to take that $3,000 and we're going to divide it by 12. That gives us $250 for interest in the first month. So $250. The difference between the amount we paid and the interest expense is going to be the amount that reduces the principal amount on the note. So that would be $828.64 minus $250. $578.64. So we're going to debit $578.64 to notes payable. Oops, we don't want to do that. We want to do this. Okay. And we're going to debit interest expense of $250. Next payment is due February 28th, 2024. We're going to do the same thing. Interest, notes payable, cash. The difference is the amounts are going to change a little bit. Cash is always going to be $828.64. The question is, how much interest expense do we have? Well, first we have to calculate the new balance. $50,000 minus the $578.64 gives us a new balance of $49,421.36. Now you can only be charged interest on the outstanding principal, so they can't charge you interest on the $50,000 because you don't owe $50,000 anymore. So we're going to take the new balance, we're going to multiply that times 6%, and we're going to divide that number by 12 to give us a monthly amount. Oops, what did I do? There we go, $247.11. The difference between the interest expense and the amount we paid is the amount that reduces the principal, $581.53. Our new balance then is $48,000. Okay. We're going to take that out so I can leave these in here for you. So that's installment note payable. Now let's talk about bonds. So if Frontier World issues 41 million of 9% bonds due in 20 years, interest payable semi-annually. We're asked if the market rate is 8%, will the bonds issue at a face amount, a discount, or a premium? And they're asking us to calculate the issue price. We'll talk about the issue price later. Here's a bond calculator link that you could actually do that. I don't expect you to calculate the issue price of a bond. I just thought you might be interested in how to do it. So if the market rate is 8% and the face rate is 9%, how will the bonds issue? Will they issue for 41 million? Will they issue for less than 41 million? Or will they issue for more than 41 million? So face amount would be 41 million. A discount would be less than 41, and a premium would be more than 41. Since the bond is paying 9% and the market rate is paying 8%, and we want a yield to maturity of 8%, this one will issue at a premium. So we can use a calculator, and I don't know if I can do this here, so bear with me. So the face value on the bond is 41 million. The annual coupon rate on the bond is 9%, and we pay semi-annually. The years to maturity are 20 years, and the yield to maturity, or the market rate that we're using, is 8%. So the bond price is $45,057,519, essentially. So you see how easy it is to calculate it using. There's all kinds of bond calculators online, so you can do this yourself if you'd like. So this actually yields at a premium because the face value is 41 and the face value is 41 and it issues at 45. Okay, let's go back to this. So for 1, it will issue at a premium. For 2, if the market rate is 9% and the face rate on the bond is 9%, then it's going to issue at face value. It's going to issue at 41 million. And then if the market rate is 10% more than the 9% on the bond face, then it's going to issue at a discount. So you can actually check those by using this calculator. You need to be able to do this part. You don't need to be able to calculate the issue price, but you need to know whether a bond will issue at a face amount, a discount, or a premium given the 2 rates. Okay, now let's actually do some entries here. For E914, we have Whitewater issuing 600,000 of 7% bonds that are due in 10 years, and they pay interest semi-annually. On January 1st, they issue them. We're assuming the market interest rate is 8%, so the market rate is actually more than the bond rate, so it's going to issue at a discount, 559,229, which is less than 600. The first thing you want to do is do the amortization schedules. So we start with the date that it's issued, 1/1/2024. The carrying value is 600,000 at that point. Actually, 559, because this one's issued at a discount. 559,229. So the issue price is 559,229. So that's our carrying value. How much interest will you pay? Well, you've promised on the face of the bond to pay 7% per year. So you're going to pay 600,000 times 3.5%. So 600,000 times 0.035. So you're going to pay $21,000 in cash for interest to the holders of the bond. Now, how much of that is interest expense? Well, we base it on the market rate. The market rate is 8%, and we take the carrying value. So we're going to take this carrying value times half the market rate, because we're doing 6 months, so times 4%, gives us $22,369. That difference is how we're amortizing that discount on bonds payable. So we're going to take the difference between these two, and just note that this is an actual absolute difference. It's not a negative or positive number. It's just the difference between these two, always in a positive. This will increase our carrying value. So we're going to take the 559 and we're going to add that difference, and I'm going to bring it up to 560. The goal is to get the carrying value up to 600,000 by the end of the 10 years. So for the second payment of 2024, what's our cash paid for interest? 21,000. That's never going to change because it says so on the bond. I'm paying 7% per year or 3.5% every 6 months on 600,000, regardless of what the bond was issued for. My new interest expense is my new carrying value times half the market rate. So market rate is 8%, so half of that is 4, gives me 22,424. The difference between those two numbers is my increase amount. That brings it up to 562,022. Requirement 2 says record the bond issue and the first 2 payments. Once you get this amortization schedule done, the journal entries are pretty simple. How much cash did you get as a company? Well, you got 559,229. Skip a line here. How much cash do you have to pay back at the end? You have to pay the whole face amount of 600,000. The difference is our discount on bonds payable. So that's 600,000 minus the 559 gives us a discount on bonds payable of 40,771. Now, what does that look like? So our bonds payable is 600,000. Discount on bonds payable, we debited for 40,771. This is a contra liability account, so it shows up as a negative on the balance sheet, and that gives us our carrying value of 559,229 on the issue date, which is what we set up here. Our first interest payment. We're going to have some interest expense. And I'm going to skip a line. I'm going to put cash. How much cash are we paying? Well, we're always paying 21,000. Oops, not 210,000, 21,000. What's our interest expense? Well, we've calculated it right here. 22,369. The difference reduces the discount on bonds payable account. That difference is 1,369, and we will credit that. So we're going to post this, the 1,369. And that gives us a new carrying value of 565.98. And see how that matches our new carrying value up here? Our interest expense is 22,369. And I'm not going to post to the cash. You know how to do that. So our second interest payment for the year, we use the same accounts, but we have different amounts. Our interest expense is 22,424. Our discount on bonds payable is 1424. And the cash amount remains the same at 21,000. If we post these things, so we're going to debit interest expense 22,424. We're going to credit discount on bonds payable. and of course cash. This leaves our new carrying value at 562,022, which is what we said up here. Now I want to point out something. When you're doing a problem like this and it asks you for the interest expense for the year of 2024, you would have to add both of these numbers together to get that interest expense. That's the amount that gets posted to the interest expense account. Okay, that's a bond that issued at a discount. Now let's try one that issues at a premium. So the same bond, same 7%, but now the market rate is 6% and the bonds issue at 644, 632. So on 1/1, it's 644, 632. Cash paid for interest is still 21,000 because it's still 600,000 times 7% or times half of 7% or times 7% divided by 2. How much is my interest expense on this one? I'm going to take my carrying value and multiply it times half my market rate, which is 3%. That gives me 19,339. The difference between these two is 1661. And notice my carrying value is above face value, so I want to reduce it. See how this is a decrease in carrying value? And back here, my carrying value was below 600,000. So I want to increase it. So this column is an increase. In this one, it's a premium, so I want to decrease. So I'm going to take 644, 632 minus 1661. Second payment of 2024, 21,000. Interest expense is based on carrying value times half the market rate, which is 3%, and then get the difference between those two. And that's what you're going to reduce the carrying value by. Okay, now the journal entries that go with that. Cash, bonds payable. So cash we got 644, 632. Bonds payable, we have to pay back 600,000. The difference is called a premium on bonds payable. And that would be the difference between this one and this one. So 44, 632. Bonds payable, 600,000. Premium on bonds payable has a credit balance of 44, 632. This leaves my carrying value at 644, 632, which is what I said on 1/1. First interest payment. We've got interest expense. We have to do something with premium on bonds payable, and we have cash. Well, we know what the cash is. It's always going to be 21,000. Our interest expense, we can get it from our table, 19,339. Our premium on bonds payable, so it has a credit balance. We want to debit it because we're working on decreasing that premium. So we're going to use the 1661 here. Interest expense, 19,339. Our carrying value is 642,971 at 630. And this is what we set up here. The second payment of 2024, same thing. Use the same accounts, except our interest expense this time is 19,289. Our premium is 1711. And our cash is always 21,000. If we post those accounts, That gives us our new carrying value of 641,260, which is what it says up here. Our interest expense for the year is the total of those two numbers, the 19,339 and the 19,289. Okay, work on this stuff, practice it, and we'll do group work on this on Tuesday. See you then.